Right now, at this very moment, a $12 trillion time bomb is sitting squarely inside the American housing market. And the fuse is already burning. Let that sink in. $12 trillion. Here's the number that should terrify you. 67%. That is how much of the average American's net worth is tied up in one single asset, their home. All their wealth, all their financial security, all their hopes stored in one asset. One asset that stands on a foundation that is cracking right now. You are about to see something in the next 20 minutes that you will never see on the evening news. And it's not because the information is secret. It's not because it's complicated. It's because it's too obvious. And the pattern has already played out 3 separate times in the last century with devastating consequences. What's happening now is not a theory. It is history repeating itself in real time. So buckle up, because I'm going to walk you through what the collapse blueprint looks like, which stage we're in right now, and why millions of homeowners, maybe even you, are about to discover that their biggest asset is actually their greatest liability. Let's begin. You need a framework, a lens through which to view this crisis, because without one, you end up believing comforting lies. The framework I use is something I call the leverage ladder. Every financial collapse in modern history, whether it was the Great Depression, the savings and loan crisis, or the financial crisis of 2008, has followed the same proven sequence, the same pattern, the same stages, the same outcome. There are 4 stages. Stage 1, the foundation. This is where optimism goes from rational to irrational. Asset prices climb month after month, credit flows freely, and everyone starts feeling wealthy. Refinancing feels like printing money, borrowing feels like investing, and no one ever asks, where's all this debt going? During 2021 and 2022, U.S. mortgage debt didn't just grow. It exploded by over $2 trillion. That was not organic growth. That was leverage, borrowed optimism. Remember this, borrowed optimism always comes due. Stage 2, the trap. Everyone is still celebrating. Prices are still rising. The media is talking about how stable housing is, how resilient the market is, how Americans are equity rich. But if you know where to look, the insiders have already begun to exit. Check the data from late 2024. CEOs of major mortgage lenders sold hundreds of millions worth of their own stock. Not because they were diversifying for retirement, they were cashing out before the story changed. When top executives sell their stock while telling you everything is fine, that's not a coincidence, that's a signal. And while interest rates remained stubbornly high, home prices stubbornly didn't correct. That tension, rising cost of debt versus stagnant asset correction, traps everyone in place. It's like scissors opening wider with your neck right in the middle. Stage 3, the trigger. This is the ignition event. It is never the thing everyone is watching. In 2008, it was subprime. In 1929, it was excessive margin debt. In every crisis, the trigger is something seemingly small, dismissed by experts and written off as isolated, until one day it isn't. Once the trigger goes off, everything changes overnight. Nobody remembers the trigger. They only see the symptom. Stage 4, the cascade. Once the momentum shifts, what took years to build collapses in weeks. Forced selling, margin calls, liquidity evaporates, asset values plunge, and suddenly every financial rule you thought was stable is revealed to be a mirage. Your house doesn't lose value because of sentiment. It loses value because credit freezes and buyers disappear. That's not a theory. That's documented history. Let me prove it. Let's step back in time. Most people think the 1929 stock market crash started on Wall Street. Black Tuesday. Bankers jumping out of windows, bread lines in front of soup kitchens, and banners saying unemployment 25%. But that was not where the crisis began. It began in Florida in 1926. Miami in the mid-1920s was the perfect speculation machine. Low taxes, booming population, and real estate values that seemed to have no limit. Land speculators were buying swampland without ever visiting it. Developers were selling plots to buyers in Chicago and New York with newspaper ads and little more than a promise. Here's how the scheme worked. Buy the land with 10% down, sell it to the next buyer for a higher price before your bill was due, repeat. Everyone was a genius until they weren't. Then, in September 1926, a Category 4 hurricane hit Miami. Suddenly, people actually went to see the land they bought. And what did they find? Half of it was underwater. Not because of the hurricane. It always was. It was swampland. Suddenly, $1 billion in real estate value evaporated overnight. That's about $18 billion in today's money. But here's the key point. No one saw the connection between collapsing Florida land deals and the national economy. People said, that's just Florida. But bad real estate loans were sitting on the books of rural banks across the country. Within 3 years, more than 600 banks had already failed. And before Black Tuesday even happened, the financial system was sick. When the market finally crashed in 1929, it wasn't the cause, it was the symptom. And here's a detail that should make your skin crawl. In 1928, a full year before the market crashed, wealthy insiders started moving their money. J.P. Morgan shipped gold to overseas vaults. The Rockefellers loaded up on treasury bonds. They saw it coming. The average homeowner didn't lose their house in 1929. They lost it in 1933 because banks began calling mortgages early, not due to default, but because they needed liquidity to survive. Millions of people who had never missed a payment lost everything because the system failed. Fast forward 60 years to the savings and loan crisis of the 1980s. This collapse isn't taught in schools like the Great Depression because it unfolded slowly, like carbon monoxide poisoning, silent, unseen, and deadly. In the early 1980s, Congress deregulated S&Ls, community banks that held your savings and mortgage. Suddenly, they could issue commercial real estate loans, and they did, recklessly. In Texas, entire office parks were financed with no tenants. By 1985, vacancy rates in the Southwest reached 30%. Here's the enraging part. In 1984, federal regulators already knew what was coming. Internal memos revealed nearly 500 S&Ls were functionally bankrupt. But instead of acting, they buried their fulfillment reports to avoid spooking the markets. That worked until it didn't. When the system finally broke in 1989, the taxpayer bill hit $132 billion. Over 1,000 S&Ls vanished. If your mortgage was with one of them, your loan was sold to a vulture fund that didn't care about your situation or your payments. Worse, many failed S&Ls had invested depositor savings into the same risky real estate they were financing. The system devoured itself, but because coastal housing prices kept rising, the contagion never fully exploded. It simply shifted elsewhere. Then came the crash people do remember, 2008. Lehman Brothers, Bear Stearns, too big to fail. But the collapse didn't begin with subprime mortgages in 2007. It began in 2004 when the SEC altered a technical rule, the net capital rule, allowing investment banks to leverage up to 30 to 1 instead of 12 to 1. That means controlling $30 for every $1 they owned. That wasn't leverage, it was gambling. Banks packaged subprime mortgages into CDOs, collateralized debt obligations, and sold them as safe investments to pension funds and retirement accounts. But they knew they were junk. In 2006, Goldman Sachs created a CDO called Abacus 207 AC1, engineered to fail and bet against it while selling it to clients. When it collapsed, Goldman made billions. Their clients lost everything. Senate hearings confirmed this wasn't speculation, it was structured fraud. When the crash hit in September 2008, 38 million Americans lost their homes within 2 years. Not from bad behavior, but because the system was rigged. The Fed's fix? Print money, over $4.5 trillion, to stabilize the system. And where did that money go? Right back into real estate? They didn't pop the bubble, they made it bigger. Now, 16 years later, we're standing under a balloon the size of the moon, and someone just pulled out a needle. Stage 1, the foundation, is behind us. 2020, 2023, mortgage rates dropped. Housing prices exploded, rising over 40% nationally in just 3 years. A $300,000 house in 2020 looked like it was worth $420,000 by 2023, but the Atlanta Fed's homeownership affordability monitor says otherwise. As of November 2024, the median household needs to spend 41% of gross income on mortgage payments. Historically, that number should be 25%, or 60% above sustainable levels. That's not a market. That's a Ponzi scheme, and we're already deep in stage 2, the trap. Warning lights are everywhere. In March 2024, the yield curve inverted for the 18th straight month, the longest on record. Every time it's inverted for over 12 months, a recession is followed within 18. Then, in August, Japan raised interest rates for the first time in 17 years. Why does that matter? Because Japanese banks hold over $1.2 trillion in U.S. mortgage-backed securities. Within 72 hours, mortgage bond prices plunged 8%, the sharpest drop since 2008. The Fed had to intervene with $80 billion in emergency purchases. And it gets worse. As of December 2024, $1.5 trillion in commercial real estate loans are maturing by the end of 2026. Many of those buildings are half empty thanks to remote work. Default rates are already at 12%, 3 times the norm. When these assets are liquidated at 50 cents on the dollar, those losses hit the same banks holding your mortgage. And that's not all. U.S. banks are entangled in $210 trillion worth of derivatives contracts, 8 times GDP. These are interest rate swaps and credit default swaps tied to real estate debt. They work until one bank fails, then counterparty risk freezes credit, just like in 2008. Deutsche Bank already reported $1.2 billion in derivative losses tied to real estate. That's not a default. That's the first crack. If one major institution fails a margin call, the entire chain locks up. Banks stop lending, stop trading, and hoard cash. The credit markets die, and the housing market dies with them. No credit means no buyers. No buyers means falling prices. The Fed knows this. That's why they've been buying mortgage-backed securities by the trillion. But they can't buy everything. The leverage is too large. Here's how the dominoes fall. Q1 2025, commercial defaults surge. Regional banks, those in Phoenix, Boise, and Nashville, start failing. Bank runs now happen digitally, not with lines. Q2, credit card defaults spike. $1.13 trillion in debt with rising delinquencies. People stop paying cards first, mortgages next. Q3, forced selling begins. Homeowners with low equity from 2021-2022 purchases go underwater after a 10% drop. Walking away becomes rational. Q4 into Q1 2026. National home prices fall 20-30%. In hot markets, more. Banks must mark mortgages to market, busting capital requirements. Lending freezes. And then 40 million homeowners realize they're trapped. Can't sell, can't refinance, can't afford to stay. And some will say, this time is different. It's not. Yes, banks are more regulated now. But Silicon Valley Bank passed its stress test weeks before it collapsed in 48 hours. 3 major banks failed in 8 weeks in 2023. Regulations didn't fail. They were just too slow. Plus, most risk has moved to shadow banking. Hedge funds and private equity, $52 trillion in assets, twice the size of the regulated banking sector. Yes, people have more equity, on average, but averages lie. 63% of mortgages since 2020 went to first-time buyers with tiny down payments. When prices fall 15%, they're wiped out. That's 28 million homes. Meanwhile, institutions now own 7% of single-family homes. In 2019, it was 2%. These investors don't wait, they liquidate. And bailouts? In 2008, the crisis cost $5.2 trillion. Today, mortgage debt is $12 trillion. Commercial is $5 trillion. Add credit cards, auto, student loans. We're staring at a crisis twice the size. The Fed's balance sheet is $7.4 trillion. The national debt is $36 trillion. Annual deficits are over $2 trillion. A bailout isn't possible, not without crashing the dollar or triggering a political revolt. So no, this time isn't different. This time is worse, because math doesn't care about optimism. Debt-fueled asset bubbles always collapse when debt service exceeds asset return. We are there. So what do? Step 1. Calculate your real loan to value. Use fire sale prices. If you're above 80% LTV, you're exposed. Above 90%, you're in danger. Step 2. Build 12 months of liquid reserves. Cash, not stocks or crypto. Use high-yield savings and T-bills. Step 3. Stress test your income. If you lost your job, how long could you cover your mortgage? If it's under 6 months, make changes. Step 4. Open a HELOC while you still can. It gives you options others won't have. Step 5. If you're liquid, prepare. Crashes create generational buying opportunities if you have cash. History repeats because human nature doesn't change. In 1929, people thought the market had reached a permanently high plateau. In 2006, they believed housing prices couldn't fall. In 2024, they believe the Fed has their back. They don't. The Fed has the system's back. And if keeping the system alive means losing your house, that's a trade they'll make every time. In every collapse, fortunes aren't destroyed. They're transferred. From those who didn't see it coming to those who did. The trigger has already been pulled. The bullet is in flight. Are you standing in its path? I'll see you in part 2, where we identify the 3 markets that crash first, the one bank signal that tells you the cascade has started, and the asset class that rises when housing collapses. Subscribe. Buckle up. Because when it breaks, it'll break fast. And mainstream news won't cover it until it's too late.